Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is Monday, October 30th. This is The Talking Point. Thank you so much for joining me. The market is trying to stay in the green. We are in oversold territory, and by any metric. And when you're in oversold territory, you try to see if you could deliver a relief rally or a bounce. Needless to say, the market wants to see if there'll be follow through if we could end the day higher. But for the S&P 500, it is extremely important because the S&P 500 fell below its 200-day moving average last week. The line in the sand for the market in the S&P 500 is 4,250. It broke well below that, and then the 200-day went with it. The reason the 200-day moving average is important, as is the 50-day moving average, it gives you a sense of confirmation in the market. In other words, that enough names, enough stocks are climbing over where they on the average of their 200-day. So climbing below is, as they say, and it's not a great saying, but nothing good happens when the S&P 500 breaks below its 200-day. But obviously, a change in tone in the market could actually come in and over, major move higher, can move it right back up. That's obviously what the market is looking for. Last week was obviously a difficult week for the market. We had a number of issues, but also in terms of raw data, the third quarter GDP report, the first read of it came in at 4.9%. Showing that the economy remains resilient. Many will point to the fact that some of it was inventories, but nonetheless, beyond that, there was a strong underpinning for the economy. We have seen, however, where companies have not been spending on capital equipment. Perhaps the reason is that they are worried about the economy. There's so much talk about a recession, an impending recession. The cost of capital has climbed higher, but overall, the U.S. consumer has more than made up for it. The other part of the story last week, too, is that we saw an uptick in new home sales, even though year to date new home sales are down, but we saw an uptick in new home sales. We also saw an uptick in pending home sales, which was good news. So this week's Federal Reserve meeting, they are going to have to acknowledge that the underpinning for the economy remains solid. The question for the Fed is, do they believe that then leads into more inflation, that the consumer continues to spend? Now, that's another issue for the market, and that is that the lower-end consumer is using credit cards. Payments are becoming late. We mentioned before that subprime auto loans are in delinquency, repossession, where they come in and take the car. That's been picking up. But we always say about the auto industry is at least you get a vehicle back. I mean, that's a common refrain that, yes, it's not good, but at least actually a vehicle returns to the owner of the bank. So in any case, this week is going to be very important for the market. So a couple of things. We will hear tomorrow about the employment cost index. All of this is part of the market's sensitivity to what the Fed is thinking. So the reason the employment cost index is important is if cost for employment pay goes up dramatically, it's concern because fear is that then that creates more inflation as one, people have more money to spend, but then they could also pay higher prices. It doesn't matter to them as much. And then that feeds that loop of companies raising their prices. But there's something more significant. When wages climb higher, companies want to pass that along. It's an input cost, and that's why that's so important. By the way, expectations for the employment cost index tomorrow is that it remains level. Also, we're going to have consumer confidence. That, of course, has been climbing lower. We want to see if it begins to inch higher, as, by the way, gasoline prices are starting to edge lower, which is good news for the consumer. On Wednesday, we are going to have the ADP employment report. That is the private sector report. Now, please keep in mind, yes, it's very important, but it does not necessarily have a 90% positive correlation with the payroll report that we have on Friday. And so it's very, how do I say that? That number comes out and then the market it becomes convinced that somehow it is equal to what we're going to see on the payroll report that Friday. It's not necessarily the case. But nonetheless, it is the private sector report, and we do pay attention to it. Expectations are that it climbs from 89,000 new jobs from the month before to 150,000 new jobs. Going to be very important. Also, we're going to have the job openings report. Expectations are that it'll be about 9.3 million new jobs, down from about 9.6. And here's what I'm going to be really focused on Wednesday. And obviously it's the Federal Reserve, but also the Institute for Supply Management, the ISM manufacturing report. Expectations are that it remains at 49. 50, as I always say, is the line in the sand. Above 50 shows expansion. Below it is contraction. What I'm looking for to see is, are we seeing any indication that this is climbing higher? I would like to see it at 50. The S&P Global report had it at 50. So I just want to report that. But the one that's mostly followed is the ISM manufacturing report. And that is showing expectations that it will remain at 49. We'll also look at construction spending. And obviously the big event is the Fed, the decision on interest rates. No one is expecting a rate hike. The Fed most likely would have suggested that a rate hike was coming. None of that was in any of the comments from the Federal Reserve speakers. However, what the market is looking for is what the Fed sees for December. And this is where it's important. What does the statement say, and how does Chairman Powell answer the questions? That is going to be extremely important for the market. On Thursday, we will have factory orders. That's expected to inch a tad higher, which is actually very good news. In essence, there's good news. Is good news bad for the market because the Fed sees it as inflationary? Well, at some point, what you want to see is that the economy is still holding up. And on Friday, we get the payroll report. The expectations are that it comes down from that really strong figure of 336,000 new jobs that we had a month ago, coming down to about 175,000 jobs. Still good, still solid, but again, not something that shocks the market, and that the unemployment rate stays at 3.8%. We will be looking at wages, and it'll be extremely important. Right now, the market expects wages consensus to just inch higher a bit. And also, we will have another report on the service sector. Expectations are that the service sector, the broader section of our economy, remains in expansion territory. In addition, this week, the Treasury Department is going to have an announcement of how much they need to have in terms of sales in their auctions. The worry is that they'll be coming in and suggesting that they have to go in with even more than the market expects. And the reason that this is important is the auctions have not, in general, been doing that well. The yields have been higher, the price is lower. So the more you have of auction, the more you have to hope that the buyers come in and that they do not push for the lower prices, again, which usually is higher yields. This is something that the market is focused on. Let me add something else here. Secretary of the Treasury Yellen was interviewed last week. She made the comment that the higher yields in the 10-year Treasury was a focus not on deficits at all, but was an indication of how strong the underlying economy is. The market had a slight disagreement with that because the market's view is that the deficits, and the deficits are very high, require a lot of borrowing from, global central banks, portfolio managers coming in and buying our debt. That's what the market thinks. Chairman Yellen, perhaps, she is correct that the underlying economy surprises us to the upside. But overall, that 10-year Treasury yield climbing above 5%, most likely the majority of that move, that it is about how much the auctions are, and more importantly, not just how much goes into auction that we expect buyers to come in, but where the market believes those buyers are going to settle at, right? That they're not just going to march in and say, well, we'll take whatever the bid is. No, the expectations are that as central banks pull back buying, that we're going to see more private buyers, and they are much more price sensitive. And that means that they will want a better price, which, is not exactly helpful for the Treasury Department. So overall, this is an extremely important week. And as I said, the earnings continues. Apple is extremely important on Thursday, given its weighting. In a rally this week, if we have an important rally this week, this is what I am looking for. I am looking to see that transports get a bid, that they climb higher, that the semiconductors get a bid and the semiconductors climb higher. I'm looking to see that all of those growth sectors actually are what leads the market higher in a rally. We are going to be looking at volume in the market. And why is volume important? Because what it does is the picture of confirmation of buyers coming in. Is there strength in it? And obviously also we want to see a broadening in the market, right? We want to see more than just the tech names, that there are other parts of the market that move higher as well. So this week is an important week for the market in so many ways. And so far, by the way, in terms of the Middle East, we're looking at gold is up. I have to say that gold, though, did pull back earlier, absorbing those higher moves. But early this morning, gold had moved up. We'll see if it holds. That is also a, safe haven. Risk. If you're risk off, you're going to go into gold. But I will tell you, in terms of seasonality, this period in the market, in terms of seasons, October and November, are usually attractive for gold. But oil prices have not surged higher. They've inched higher and pulled back. And we don't see that there's been a huge move into treasuries just because of risk aversion. That means that the market believes that the conflict still remains contained. So we're keeping an eye on it. And as I've said over and over again, crude oil prices will be the most noticeable and susceptible to any change in the direction of this conflict. Have a very good week. We'll be back next week. Thank you.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of the LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.